What if I told you that one of the most important indicators in the entire precious metals market is quietly setting up for a move that almost no one alive today has ever seen? The gold-silver ratio, a powerful measure that tells us how many ounces of silver it takes to buy 1 ounce of gold, is now moving in a way that could completely reshape how investors think about wealth, money, and opportunity. Right now, most people are still focused on short-term price moves, small corrections, and daily noise. But underneath all of that, a much bigger story is unfolding. A story that points toward the possibility of the gold-silver ratio collapsing into single digits. And if that happens, it would mean something massive. Silver could outperform gold in a way that shocks the entire financial system. Welcome to Gold-Silver Scope, where we break down complex market moves into simple, clear insights so you can understand what's really happening behind the scenes. At the moment, the market is in what we call a transition phase. After a very sharp move downward in the gold-silver ratio, we are now seeing a temporary reversal. This is completely normal. Markets never move in a straight line. When you have a steep drop, you almost always get a bounce. That's exactly what we are seeing right now. The ratio dropped as low as the low 40s, around 43, and then rebounded back up to the mid-60s. On the surface, this might look like strength returning to gold over silver, but in reality, this could just be a pause before the next major move. In technical analysis, we often talk about market moves happening in waves or impulses. Typically, you see three main impulses in a trend. Right now, it looks like we've already seen two major moves, and there is a strong possibility that a third impulse is still coming. Now here's the key detail. The third impulse is usually the smallest and the fastest. That means if the next move down in the gold-silver ratio begins, it could happen quickly and catch most investors off guard. But markets are never guaranteed, and there is always another scenario to consider. If we see a major global financial shock, something like a credit crisis, banking instability, or a sudden collapse in risk assets, then the gold-silver ratio could temporarily move higher instead of lower. In simple terms, during panic, investors rush into gold first because it is seen as the ultimate safe haven. Silver, being partly an industrial metal, can lag behind during those moments. However, for the long-term bullish case in both gold and silver, what we really want to see is a breakdown in the ratio. A falling gold-silver ratio means silver is outperforming gold, and that is where the biggest gains historically happen for investors. Right now, the chart structure suggests something very important is forming. We are likely inside a pattern that is building pressure, similar to a coiled spring. This kind of setup usually leads to a strong breakout. The question is not whether a big move is coming. The question is which direction it will go first. And this is where patience becomes critical. Because in markets like this, the biggest opportunities come to those who understand the structure, not those who react emotionally to every small move. As we move deeper into the structure of the market, it becomes very important to understand the exact pattern that is forming right now, because once you can see the pattern clearly, you can start to understand where the market is most likely headed next. At this stage, the gold-silver ratio appears to be forming what is known as a falling wedge pattern. Now, in simple terms, a falling wedge is a structure where prices move lower over time, but the moves become smaller and tighter. This shows that selling pressure is slowly getting weaker. Even though the market is still moving down overall, the strength of the sellers is fading. And when that happens, it often leads to a powerful breakout. Inside this falling wedge, we usually see three key impulses. These are three pushes in the same direction, each one slightly weaker than the last. Right now, there is a strong possibility that we are either finishing the third impulse, or we may still see one final move before the pattern is complete. This is where things become a bit tricky, because markets don't always move perfectly. Sometimes that third move can extend a little further than expected. So what does this mean in simple words? It means the market could still have one more drop in the gold-silver ratio before the real breakout begins. And if that happens, it could be the final shakeout, the move that scares out the last weak hands before the trend reverses strongly. At the same time, there is another important line on the chart that we need to pay attention to. This is what we call the descending resistance line, or the capping line. This line has been rejecting the price again and again. Every time the ratio moves up, it hits this line and gets pushed back down. You can imagine it like a ceiling that the market keeps hitting. Now here's the key moment, the break of this line. The moment the gold-silver ratio breaks above or below this structure with strong momentum, that's when things start to move fast. If the ratio breaks downward from this wedge, it would confirm that silver is about to outperform gold in a major way. And historically, when that happens, silver doesn't just move slowly, it moves aggressively. On the other hand, if the ratio continues to move sideways or slightly upward for a bit longer, it doesn't necessarily change the bigger picture. It may just mean the pattern needs a little more time to fully develop. Markets often take their time building these structures because the bigger the move that is coming, the more pressure needs to build first. Now let's also talk about gold itself, because gold is not showing the exact same pattern as the ratio. Instead of a falling wedge, gold appears to be forming a broadening structure. This is a pattern where price swings become wider over time, showing increasing volatility. Recently, gold experienced a very strong sell-off, even larger than its previous correction. This tells us that the market was shaken quite hard. But what's interesting is how gold reacted after that drop. It quickly recovered and formed what traders call a hammer candle, which is a strong sign that buyers stepped in aggressively and pushed the price back up. Before that, there was also a shooting star candle, which usually signals weakness. But the market completely reversed that signal with the hammer move. In simple terms, gold neutralized its own bearish signal. This is a sign of underlying strength. However, just like with the ratio, gold also has its own resistance level, another descending line that needs to be broken before we can fully confirm the next big move upward. And this level is still some distance away, which means gold might continue moving higher gradually before giving a clear breakout signal. There is also something important that many investors don't understand. Even after a breakout happens, markets often come back to test that breakout level again. This is called a return move. So even if gold breaks higher, there could still be a temporary pullback before the real trend continues. All of this tells us one thing: we are in a build-up phase. The market is preparing for something bigger, but it hasn't fully revealed its direction yet. To truly understand what might happen next, we need to step back and look at history, because markets have a habit of repeating similar patterns again and again. And when you recognize those patterns early, you gain a huge advantage. There was a previous period where gold formed a structure very similar to what we are seeing today. It was not exactly the same shape, but the behavior was very close. Back then, gold spent a long time moving sideways. Prices were not doing much, and most investors became bored and lost interest. This phase lasted for years. From around 2020 into 2023, gold was stuck in a range, moving up and down without any clear direction. Now this is where most people make a mistake. They think nothing is happening. But in reality, this is where the biggest moves are being prepared. During that time, gold was forming a broadening structure. The price swings were getting wider, and pressure was slowly building. There was also a key level around the 2000 mark that kept getting tested again and again. Every time gold reached that level, it faced resistance, but each time it came back stronger. This repeated testing of a key level is very important. Because eventually, when that level breaks, it doesn't just break quietly, it explodes. And that's exactly what happened. Once gold finally broke above that long-standing resistance, the move that followed was massive. Gold didn't just go up a little bit, it surged from around 2,000 all the way up to approximately 5,600. That's a move of about $3,600. And this didn't happen randomly. It was the result of years of consolidation, pressure building, and structure forming. This is one of the most important lessons in investing. The longer the market stays quiet, the bigger the move that follows. Now, when we compare that past structure to the current one, we notice something interesting. The current pattern is not as long in duration. That means the waiting period may not be as extended this time. In simple terms, the breakout could come sooner. However, we still need to be realistic. Even though the structure may complete faster, there is still a possibility of one more temporary drop before the final move begins. Markets often like to create one last moment of doubt before moving in the expected direction. Now let's bring another metal into the discussion: platinum. Platinum is often overlooked, but it plays an important role in understanding the bigger picture. It sits somewhere between gold and silver. It has both monetary value like gold and industrial use like silver. Because of this, it often behaves in a way that gives us additional clues about where the market might be heading. Right now, platinum is showing a structure that looks very similar to silver. It has experienced sharp drops, but each time it drops, buyers step in aggressively. This is visible through what traders call hammer candles, where price moves down but then quickly gets pushed back up. We can see multiple instances where platinum tried to fall, but was immediately bought up. This tells us that there is strong demand sitting below the market. At the same time, there is also a clear resistance line above, where prices keep getting pushed down. So what we have here is a market that is being squeezed between buyers below and resistance above. And just like with silver, this kind of setup usually leads to a strong breakout. The question again is timing. Will it break now, or will it take one more pullback before moving higher? There are two main scenarios. In the first scenario, platinum breaks above resistance soon. This would signal strength across the entire precious metals sector, especially for silver. In the second scenario, platinum moves up toward resistance, gets rejected one more time, and then dips slightly before finally breaking out later. But here's the key point. In both cases, the direction after the breakout is expected to be strong. And looking further ahead, if we extend the timeline to 1, 2, or even 3 years, the outlook becomes even clearer. There is a high probability that gold, silver, and platinum could all move toward new all-time highs. This is not based on hype or emotion. It is based on structure, history, and how these markets behave during certain economic conditions. Now let's move beyond charts and patterns and talk about the real force that is driving this entire market: the global economic system itself. Because at the end of the day, gold and silver don't move randomly. They respond to what is happening in the world, especially when it comes to money, debt, and the value of currencies. Right now, we are entering a phase that can be described as economic pressure from all sides. Growth is slowing down, the cost of living is rising, and at the same time, governments and central systems continue to increase debt and print more money. This combination creates a very powerful environment for precious metals. In simple words, when more money is created but real goods and services don't increase at the same pace, the value of that money starts to fall. This is what we call currency debasement. And when currencies lose value, investors naturally look for something that can protect their wealth. This is where gold comes in first. Gold has always been seen as a store of value. It doesn't depend on any government. It doesn't carry credit risk, and it cannot be printed. That's why during times of uncertainty or currency weakness, money tends to flow into gold. But here's where it gets interesting. Once gold starts moving and confidence builds, Silver usually follows, and often moves much faster. This is because silver is a smaller market, and it has both monetary and industrial demand. So when capital starts flowing into silver, the price can accelerate very quickly. Now let's understand something very important that most people miss. When you look at charts of commodities like copper, oil, or even silver, they may appear to be rising strongly, but that is usually measured in dollars. And if the dollar itself is losing value, then part of that rise is actually just the currency getting weaker. This is why serious analysts often measure assets in terms of gold instead of dollars. Think of gold as a stable measuring stick. Instead of asking how many dollars is this asset worth, we ask how many ounces of gold is this asset worth. This gives us a much clearer picture of real value. When we apply this method, something surprising happens. Many assets that look strong in dollar terms are actually losing value when measured against gold. Take copper as an example. On the surface, copper prices may look like they are going up. But when you divide copper by gold, meaning you measure copper in gold ounces, you see a different story. Over time, copper has been losing value relative to gold. In fact, compared to previous years, copper has significantly underperformed. What this means is simple. Gold has been the stronger asset, even if it doesn't always look that way in dollar charts. The same concept can be applied to many other commodities. Even oil, which recently showed strength, is still expected to underperform gold over the long run. Short-term moves can happen due to geopolitical events or supply shocks, but the bigger trend often returns to the same point. Gold tends to hold its value better over time. Now you might ask, why is this happening? The answer lies in the role of energy and finance in the global system. Energy markets, especially oil and gas, are extremely powerful. They affect transportation, production, and daily life. Because of this, they are often used as tools to influence inflation or deflation. When energy prices rise sharply, it increases costs across the entire economy. This can create inflation. On the other hand, when energy prices fall, it can slow down economic activity and create deflation. In many cases, these movements are not purely natural. They can be influenced by policy decisions, global tensions, or financial strategies. But here's the key takeaway. While these forces can create short-term volatility, they often lead to long-term instability in currencies and financial systems. And when that instability grows, the demand for hard assets like gold and silver increases. Another important point to understand is that not everything that goes up in price is a good investment. Some assets may rise simply because the currency is losing value, not because the asset itself is becoming more valuable. This is why comparing everything to gold gives us a clearer truth. Right now, the data suggests that gold is still winning in relative terms. It is maintaining its strength better than most other assets. And if this trend continues, it supports the idea that we are still in a long-term bullish environment for precious metals. All of this connects back to the bigger picture. We are in a system where debt is increasing, currencies are weakening, and economic pressure is building. This kind of environment has historically been very positive for gold, and eventually even more explosive for silver. Now let's bring everything together, because when you connect all the pieces, the gold-silver ratio, the technical structures, and the global economic backdrop, a very clear picture starts to form. We are not just looking at a normal market cycle. What we are seeing right now is a build-up phase before a potentially historic move. The gold-silver ratio has already shown signs of weakness after reaching extreme levels in the past. Even though it has bounced recently, the overall structure still suggests that a downward move is more likely over time. And if that move continues, it could push the ratio much lower than most people expect, possibly even towards single digits. Now think about what that really means. A falling gold-silver ratio doesn't just mean silver is going up. It means silver is outperforming gold at a much faster rate. And historically, when that happens, silver tends to move in powerful, explosive waves. At the same time, gold itself is not weak. In fact, it is holding strong and forming a continuation pattern. Once gold confirms a breakout above its resistance levels, it could begin another major leg higher. And when gold moves up in a strong trend, it usually pulls the entire precious metals sector with it. This creates a powerful combination: gold rising steadily as a store of value, silver accelerating faster as a high beta asset. The ratio collapsing as capital shifts towards silver, and this is exactly the kind of environment where some of the biggest gains in the market can happen. But timing is everything. In the short term, there is still a possibility of volatility. We could see one more pullback, one more shakeout, or even a temporary move against expectations. This is how markets work. They test patience before rewarding it. There is also the risk of a broader financial event. If we see a sudden crisis in credit markets, banking systems, or global liquidity, gold could temporarily outperform silver again, pushing the ratio higher for a short period. But even in that scenario, it would likely be a temporary phase within a bigger long-term trend, because the larger forces are already in motion. We are living in a time where currencies are being weakened, debt is expanding, and the cost of living continues to rise. These are not short-term problems. They are structural issues. And historically, these conditions have always supported the rise of hard assets like gold and silver. The key difference this time is the scale. If the current patterns play out the way they are setting up, we could see moves that are much larger than what most people are prepared for. Silver reaching extremely high levels, gold continuing its long-term climb, and the ratio moving into territory that modern markets have never experienced before. So what should you watch? Keep your focus on a few key signals. A confirmed breakdown in the gold-silver ratio. A breakout in gold above major resistance levels. Strong upward momentum in silver and platinum. Continued weakness in fiat currencies. These are the signs that the next phase has truly begun. And remember, the biggest opportunities don't come when everything is obvious. They come when the structure is forming, when the signals are building, and when most people are still uncertain. If you want to stay ahead of these major moves and understand what's really happening in the gold and silver markets, make sure you stay connected with Gold Silver Scope. This channel is all about giving you clear, simple, and powerful insights so you can see opportunities before the crowd does.